answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hanson.
I'm Pat McClain.
Glad you are with us today as we talk about financial matters. Both myself and my co-host, we are both financial planners, certified financial planner, chartered financial consultant. We spend our weekdays working with you, helping be your financial advisors on the air, and our weekdays meeting with people like yourself. I don't know if I said that correctly. I'm reading something as I'm speaking. It's not the best thing for me to be doing.
Anyway, we're here to answer your questions and try to help you with your financial situations. And if you'd like to join the show, it's 833-99-WORTH, 833-999-6784, and it's Allworth Financial's Money Matters, formerly Hanson McClain, Simply Money, a couple other firms. What we changed our name to is Allworth, representing all your worth, which is not only your investments and financial planning, but taxes, estate planning, and we actually have relationships with Medicare supplement brokers. So if you have those needs, we are here to help you. So Allworth.
And before we take calls, I want to bring everyone's attention to this. And I think we've talked about these products a couple of times in the program, but there's an article in the Wall Street Journal a few weeks back, and it highlighted one particular, I'll call him a speculator, his investment and what happened to it. But it had to do with exchange-traded notes, ETNs. These are very different than ETFs, exchange-traded funds. Exchange-traded funds, I think many of us are familiar with, they're very similar to a mutual fund. It's a way for us to own a basket of stocks that we can get in and out of easily. Exchange-traded notes are products that are developed by bank and brokerage houses, Wall Street firms, essentially, and they tend to be in a very specific asset class. And
sometimes they don't even own it; they just track indexes, which is oftentimes the way these exchange-traded notes. But people treat them like they're exchange-traded funds, and they're not exchange-traded funds.
It's one of those things. Wall Street can create all kinds of crazy products, right? And they can create all kinds of crazy products. And oftentimes I scratch my head like, how is this going to benefit an investor? How is this going to yield someone any more income for their retirement or for the family or their financial goals? And I think by and large, some of these products are built because it's going to be good for.
And why does this matter? Well, as you see the proliferation of trading platforms and the cost dropping
or to zero
in many cases, these products become more accessible and easier to trade. So one of the things that's popular with the kid, we call them the kids nowadays, is a trading platform called Robinhood. And Robinhood apparently takes from the rich and gives to the poor, but I don't understand. How they didn't see the irony in a trading platform that called itself Robinhood.
And here's why we're talking about this. Not because I think you're going to go out and buy an ETN, but oftentimes people look to an investment to solve their financial problem. And one particular there's no silver bullet. There's no magic elixir. There's nothing that you're going to be able to do. If you're behind in your finances, you're going to have to save more and be more disciplined, period. If you don't have enough money saved for retirement, you're going to have to either work longer, or you're going to have a lower standard of living in retirement.
That's how it works.
And if you try to go down some other path thinking that, well, maybe if I can get lucky in this area,
it oftentimes compounds the problem.
Yes.
because there is no magic bullet. So this is a story of this gentleman who lost $100,000 in August by doing something he shouldn't have been doing. He bought it. He actually bet against,
sold something short, a security short,
an exchange traded note, and he didn't quite understand the product to begin with.
Well, it was a 3 times the inverse of a natural gas exchange traded note.
Crazy.
3 times I don't even know what that means. But so this exchange traded note was already betting triple.
It bet triple short.
And this guy decided to bet it short even further.
Crazy. It's like
I think in the price are going
to. It's like leverage, unleverage, 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 and then by the way.
But what had happened is because the market of these exchange traded notes is so illiquid, there's just not a very big market. The prices themselves can go haywire and don't necessarily reflect the underlying realities. And what ended up happening is the price of this note went up to the point where his brokerage house said, "Hey, you got a margin call here. You got a short position. You needed some cash here to cover this thing." So he was forced to sell out, took a $100,000 loss. And I read this.
He said a significant portion of his and his parents' net worth.
His parents' money.
Yeah.
He's investing his parents' money in this.
This, quote, "This was absolutely frightening for our family," adding that the loss wiped out a significant chunk of the investment portfolio he managed for himself and his parents.
So here's this 38-year-old taking his cash and some of his parents' money. He hasn't a clue what the heck he's doing. And I got to tell you, I'll be real honest. I read this and I first thought, well, this is just foolishness, what he did. And then I thought, why would you allow a story to be written about this and have your face and everything in it? Unless it wasn't like this. I don't think it was.
There's a picture of him.
I don't think this could happen to you too. So be careful.
Oh, that's interesting. I didn't actually really think of it like that.
Well, that's what I thought. I mean, we've all done stupid things in our lives.
I don't want to read about it in the Wall Street Journal.
No, I don't want something bringing out my dirty laundry.
Someone calls me, "Hey, Pat, I did a little article here. Tell me all the stupid things you've done with your money and send me a picture."
And for that matter, how about all the stupid things you've done in life? All your shortcomings and failings.
And I'm like, how many volumes is this book?
The bottom line on this, and the reason we wanted to briefly bring this up at the start of this program, be careful. Don't let a bull market confuse you for being a smart investor.
Yeah, and don't buy something you don't understand. Do not buy something you
and don't sell short anything for crying out loud. That is
actually. So I had a friend that was opening a. He was building a hotel, and he said to me, he showed me his pro forma, all the numbers, and he looked at it. He goes, "Look, Pat, look at this. It looks great, doesn't it?" And I said, "Oh, there's something that there's many things that can go wrong."
Oh yeah.
And he said to me, "What could go wrong?" I said, "I actually can't even tell you what it's going to be.
I don't know the industry that well. What am I supposed to be?
But there's going to be something." And he said, "Well,
this is pre-pandemic."
Yeah.
Yeah.
So anyway, I was talking to him. I'm like, "Hey, do you remember the conversation we talked about all the things that could possibly go wrong in your investment in a hotel?" He's like, "Yeah." I'm like, "Was pandemic on that list?"
Missed that one.
Right? And the point being is, look, that's why you have a diversified portfolio. That's why you spread things away. That's why you don't actually say, "This scared us to death. There was a significant portion of our life savings lost in this bet."
This week at the gym, a friend of mine came up and chatting with him briefly, and he's probably mid-50s, successful guy. He's got a business. And he said to me that, I'm really glad the stock market's doing so well, which I always find an interesting comment because I care much more about the economy than the stock market.
Yeah,
because the prices are going to follow the economy. I want the economy to do well.
By the way, the stock market is not doing anything. It did well.
But he said, at the kind of the height of the pandemic, I moved everything into large cap growth, which is the area of the stock market that's done the best during that time. He said, yeah, I just don't know what to do. And I kind of look, I'm thinking, I don't know what response you want from me, but all I said is, be careful that you don't think that you can outsmart the. I think what I said was, I've realized over the years that I'm not smart enough to outsmart the market. So be careful.
Yes.
So what the question is, was he lucky or did he?
Depends on what he does next. So let's go to the calls.
Right.
833-99-WORTH, 833-99-WORTH.
We're talking with Chris. Chris, you're with Allworth Money Matters.
Hey, Scott and Pat, thanks for taking my call. I've been listening via podcast for the past couple of years, and the only comment I would like to make is they're not long enough.
Oh,
I listen
thank
to
you.
your show while I do yard work and walk the dog, and I always run about a half hour short on the podcast. So
Don't do as much yard work.
Them. Yeah, thank you. But, hey, so I have a question for you, and I know you've addressed this on the show a couple of times, but I really haven't gotten what I feel like is a solid answer. But I'm 50. My wife is 54. We've been really good savers, and we feel we're in a position to where we can start downsizing our careers. But the big question when you do that, when you're our age, is healthcare.
Oh,
Because
yeah.
obviously, we're not going to qualify for Medicare for another decade plus. And so I've done a little research on my end, and you can obviously just go straight to healthcare insurers and purchase policies.
Yep.
But
And have you
that's
talked to
very,
some of those
very
people?
expensive.
It's very
I
expensive.
have not yet.
Healthcare is very
Yeah, it's
expensive,
well,
period.
I mean, I've gone to because currently we're with, I live in Northern California. We're with Kaiser Permanente, and I've just gone to their website and looked at what their rates are. But then I've also stumbled across, as part of the Affordable Health Care Act, as you know, the California Health Exchange. And just kind of playing around with the website, and you're probably aware of this, if you keep your income below your taxable income below certain levels, you qualify for subsidies, and that can dramatically drop the cost of health care. And so I just kind of wanted to know your
I've seen
feeling on that.
I've
Obviously,
seen people with millions of dollars in assets qualify for subsidized health care under this program.
And that's kind of where we're at, because we're sitting on millions of dollars in assets, and essentially, I mean, I feel like I'm too young to fully retire, but I want the flexibility of not having the 8 to 5 gig with all the corporate pressures. And by having my own health care, you can essentially do, because when I ran down the math in terms of we have no debt.
So what? Let's say you continue with Kaiser. What would that cost you?
So if I did it through them directly, because I still have one in the nest, it's about $1,300 a month. But if I kept my income, I was playing with some figures online on the health exchange, I could keep the same. And these are high deductible plans, which I'm comfortable with because we're in good health, and we can afford the deductible in case something bigger came along.
Mm-hmm.
But if I go to the health exchange, and I was playing with the numbers, and I don't think they tell you the exact numbers. There might be some information in there if you really look hard. But if I kept my taxable income below about $85,000 a year based on my family size and dependence, it would drop that down to like $200 a month.
Okay.
For the same plan. But if that income went up to, let's say, like I mess with it to like $120,000 per year, then essentially you lost all the subsidies, and you're basically reverted back to that $1,200 or $1,300.
So it's about a $12,000. And can you get a Kaiser plan through the exchange? Can you keep your same?
Yes, absolutely.
Okay.
Just a high deductible.
So it's about a $12,000 subsidy based upon your taxable income being either below $80,000 or above $100.
And can you live comfortably on $80,000 a year?
Well, that could be
easily.
taxable
Well,
income.
well,
you can structure things in such a
Oh,
manner.
that's true.
So my asset breakdown, I've been very fortunate.
What's your net
in some
worth?
areas,
What's your
but,
net worth right now?
Net worth, if you want to include the house, house is about $5.3
Okay,
million.
listen. Do not let health insurance drive your career decisions.
Did you say 5 point?
Regardless.
Did you say
That's exactly what my buddy said. My buddy said, "Dude, you got plenty of money. Just put $200,000 away in the separate account for health
That's right.
care.
You
and
said-
don't worry about it."
I would agree.
I mean, the kind of saver that I've been. You think about these things, right? When you're laying the bills down line by line, you go,
The
"Man, healthcare's
future,
gonna be your biggest
okay,
bill by
but
far."
yes,
Wait, but Scott, I missed it. Did you say your net worth was $5.3 million?
yes.
Oh,
Yeah,
what
if you include
the-
our house. If
yeah,
you include our house, I mean,
What's your house worth?
Basically,
What's the house worth?
About $500,000.
And do you owe
then
any
you're gonna
money
tell
on
me
it?
$4 million or something. So good.
Do you owe any money on the home?
Well, so it's broken down, and we've been very good about this because our income has been so high, we haven't really been able to qualify for Roth IRAs, right?
Mm-hmm.
And so,
Chris, let me ask you this:
we've been
Are
really
you
good
burnt?
about-
Are you burnt out in your job?
Yeah, pretty much.
All right,
Listen,
then
That's
just
pretty much
move
what-
on.
I got to tell you, I've spent 30. Listen, I spent 30 years helping people move from the workplace into retirement. Some people I talk to love their job. It's bittersweet when they're going to retire. Maybe they're doing it because they have to or whatnot.
Yeah.
But a large portion of people I talk to and they say, I can't stand my job. I can't do the travel anymore. I can't, like, I have, how many more years do I have to work before I can quit doing this? And I've coached people and guided people along that. And I think really, you're 50 years old. Like, if you're not digging what you're doing, figure out a way to go find something that you're going to love doing.
Yeah, and don't let the health insurance be the driver.
Yeah, and I think that's the biggest thing. Right?
You've got the luxury of the financial independence. You've got that.
Yeah.
You've worked your butt off. You are there. So you don't need to work for financial independence.
So if you could show up and do a job anywhere, if I said to you, Chris, you have to have a job. You have to have a job. I don't care what it is. What would it be?
Yeah, and that's the part you got to answer, right? So
Right.
It's kind of crazy, but life tends to repeat itself, right? So I come from a family that did exactly the same thing I did, and so basically, I think I kind of just learned by example, right? And so my parents retired in their early 50s, but again, I don't really want to call it retirement because when you're really young like this, it's really just like you said, another stage of your life.
That's right.
And so I kind of fall into the same thing, and I'm really big into like teaching and volunteering and how can I mentor other people so that, they can enjoy some of the same things that, I've enjoyed and learned over the years. And so I think it'd be a multiple things, right? Because I enjoy outdoor activities and other things. We enjoy hiking and traveling and all these other things. But at the same time, I think the volunteerism.
Okay, well then that's good enough. As long as you have some purpose. What you don't want to happen, what you'll find is if you retire at age 50, you're not gonna have a lot of your friends
don't have the same flexibility.
There's no one to play with, right? And there's no one to
all the old people, right?
Yeah. There's no one to play with. I was talking to a friend the other day, and he was telling me about golf. And he's self-employed, and he goes, "Oh yeah, I've been golfing a lot." I said, "What's the average age?" And he's 55. I go, "What's the average age of the people you golf with?" He says, "They're all in their late 60s, early 70s, which is fine, right?"
Yeah.
So, but the point being is that you have to have purpose.
I think, Chris,
but don't let this.
I
health
agree with your
insurance.
friend. And you could. That's. We're talking about $12,000 a year. You got $5.3 million. Whichever way it swings is not going to have an impact on your life.
And by the way,
and you'll want to be prudent and try to do save as much as possible here. But you've worked hard. You've saved hard. You don't accumulate $5 million by not being a disciplined saver. So you've worked hard to save these dollars, to have financial independence. You're there. So you can keep doing your career if you want to do your career. I love what I do, and I'm fortunate I've got some flexibility. Maybe it's because when you're co-CEO, you've got some flexibility. So I love what I don't. I hope to be able to keep working until I'm who knows when, right? And I'm 54. I'm about your age, but. When you're at the point where work is an option and not an obligation, it's quite freeing. And if you're not loving your job, go do something else and forget about it. And don't let the paycheck be the number one factor, which it probably was when you were younger.
Yeah, and it's just all those things. It's really, like I said, it's the unknown, and it's just unfortunately, when you've been doing this for the last 30 years the way I have, and the way we've saved, it's really hard.
Oh yeah,
of course
it is.
Yes, it is.
Yeah. Oh yeah.
It's really tough. So I think what I need to do is come to Scott and Pat therapy, and then you can sit down. You guys can coach me how to unwind and go, dude, enjoy it, right? Have a good time.
It's hard.
Yeah, it is hard. It is a dichotomy because the people that are the best savers tend not to oftentimes they don't know how to enjoy the finances so much. They're the ones that end up the most amount of financial independence, but they don't they don't always have the same amount of confidence, and they tend to have some fear.
And it comes from a source of scarcity. It's a scarcity mentality. And it's hard to change.
Well, and I think a big part of it too is, so I graduated college in the early 90s, started my career. Well, pensions by that time were on the way out, right?
Yeah.
So that was when
you
had to kind of create your own pension. So there's not that safety net. So you got to rely on yourself. And I think I've been very good. And I've had advisors. I have an advisor, and we've done some really good things, I think. But at the end of the day, it's that kind of that unknown,
That's right.
like you're saying, and trying to figure out.
Chris,
so that leads me into another question for you, real quick. I know
Go ahead.
I've been talking for a while.
That's all right.
But so when it comes to making withdrawals and drawing down assets, there's the popular one of the popular theories is the 4% and then adjust for inflation each year. And then the other one that I'm not finding as much information on is using the RMD table. And I just want to get your thoughts on either of those or both of those, or if you even think any of those are valid.
So you've got roughly just under $5 million outside your home in investable assets. How much of that is in IRAs, 401ks, that sort of thing?
Okay. Yeah. So qualified versus unqualified,
yes,
right?
Thank you. Yes.
So it's almost even split, and so essentially in that it was about 4.8 million in total assets. About 200,000 of that we have earmarked for our daughter, who's college age right now, and about 100 of that is in a 529, and another 100 of that is in a custodial account, which she could access at any time, but she doesn't even know it exists.
Okay.
So of the remaining, it's almost a 50-50 break between 401ks and IRAs and brokerage accounts and basically laddering CDs and money market.
Well, the thing is, if you're at a time where you want to do some career change, I wouldn't worry too much about it. I would say you've got cash set aside. You've got places that don't.
But Scott, the one thing that I would look at is if I wouldn't start a 72T off one of these IRAs now. But if he was
in a couple of years,
you might in a year or two, because I would see if you were actually going to re-enter the workforce.
And if you won't know until you have some time off.
Until you have some time off. And if you, after a year, said, I'm definitely not re-entering the workforce, then I might consider a 72T distribution on an IRA.
Roth conversions.
Or a Roth conversion.
I do Roth conversions.
Yeah.
If you have some low income years.
Yeah. Or a combination of the two.
While you're on the California Health Exchange, subsidized by the taxpayer.
Yeah.
Yeah, or possibly a combination of the two.
Chris, I'm teasing. I'm teasing.
Oh, you didn't pay your fair share. Don't give us that. That's whatever. People say fair share. I always get stuck with what the word fair means. I don't know what word fair means.
Yeah, that's a good point. Yeah,
right?
That's a good
fair
point.
Compared to who?
Yeah.
Who says it's fair? Anyway, we appreciate the call.
Yeah.
Congrats.
Yeah. All right. Thanks, guys.
Yeah, thank you.
Appreciate it.
Yeah, thanks, Chris. I don't know if you saw a couple of years ago when it was about all of a sudden 50 Cent, the rap hip hop guy. 50 Cent.
Yes.
Did you see this a couple weeks back?
He came out because he didn't like the taxes.
I don't want to be 20 Cent. That was one of the funnier things.
Well, he came out because he was his economic interest overrode most of his other interests, maybe, huh? I don't know how that works.
I guess. I thought, I appreciated this previous caller for a couple of things. One, obviously, he did a great job saving, and most people at age 50 are not going to. Their careers aren't going to be such that they're going to be able to accumulate $5 million, right?
Yeah, and he may have had a couple of things in there,
Whatever,
right?
But you can be in a point where you can accumulate some dollars, and if we've worked with a lot of people in their 50s that are counting down the years until retirement, not loving what they're doing, but figure that this is what got them to where they are now if they put in those next few years. But sometimes it makes sense to do a career change, even at this point.
And work a little longer at something you enjoy.
Because
life is not a dress rehearsal. You only got one shot at this thing. And it's not all about the money. It is not all about the money.
Nor is it all about not working.
That's right. And so money, like this FIRE movement, right? Financial independence, retire early. Which, by the way, most of the people that actually write about the FIRE movement say they're in the FIRE movement, but they're writing articles for money, which just kind of counters the FIRE movement. They're normally bloggers or vloggers.
I don't know many people who are fulfilled in life that aren't being somewhat productive and in the service of others in some aspect.
How would you? You wouldn't know who they were. They would be.
Okay. Well, maybe there's some of those people out there.
They would be like at home they wouldn't be in.
But there's some good planning that can go on. And by the way, if that kind of resonates, talk with a financial advisor or talk with an Allworth advisor to say, hey, what would it look like if I went from making $130,000 a year
to 60 grand, and I worked as a
whatever.
I worked as a substitute teacher. I worked as a teacher. Whatever
you're thinking about doing.
The passion is.
As your point, it's not a dress rehearsal. You have one chance through this thing.
It's not all about the money.
Yeah. Although this is a money program, and we're going to take a quick break. When we come back, we'll talk more financial topics. This is Allworth Financial's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. If you'd like to be part of the program, 833-99-WORTH is the number. Let's talk with Faith. Faith, you're with Allworth's Money Matters.
Hello, guys. Here's my deal. I sold my home in April of this year. I got $148,121. I have $100,000 that's in my credit union savings.
In addition to this 148.
No, that's from the 148.
Okay.
Got it.
Okay. I want to know what should I do with that money? I want safe money. I'm 71 years old, and I sold my house and moved into a senior community. I want to know, should I put my money in a CD for 3 to 6 months at a time? Keep it in my savings? I'm not sure what to do with it.
So, Faith, what happened to the $48,000 difference between the proceeds and the money in the credit union?
I was heavy in debt. I paid off about $27,000 in debt. I gave my daughter some money. I bought new furniture, everything new. Out of that $148,000, I have $18,740 left. That's in a separate savings account.
And
other than that,
how are you paying for your monthly expenditures at your new place?
I am on Social Security and a small pension, which is about $2,777 a month.
It's just about $2,777.
Yeah, that's what it is.
And what does it cost you to live in this senior community?
Well, my rent is $1,254. I don't pay electricity. The only thing I pay is cable and my phone. So I have car insurance, which is $140. I have my cable, which is going up. I pay $200 a month for my cable.
Do you have internet?
Yes.
All right. Do you have an Apple phone? You should get Apple TV.
Got all the package.
I have an Apple phone.
Yeah, look at Apple TV.
She's got the Hulu.
Look at Apple TV as an alternative to cable, but that's just that's an aside. You should leave it in the bank.
Yeah, I agree with Pat.
You don't buy a CD. Don't tie it up. What I'm worried about you, Faith, is right now it sounds like you're about break even. You've got the same amount of money coming in as the same amount that's going out. Is that correct?
Yeah, pretty much.
Okay. I'm afraid what I don't want to see you doing is using this money. I don't want to see you getting into debt, because you said when you moved out of your old house, you had $27,000 in consumer debt.
Right.
And so I don't want you to buy an annuity at the bank. You might run into the guy at the bank and they're like, go talk to the guy in the corner, the lady in the corner. They're very nice. They're going to tell you about this great annuity. Don't buy any of that garbage. You don't need that. I'd either go to an online bank if you're comfortable. If you're not comfortable, it's not going to make that big of a difference. Just keep it in a regular savings account. You're looking at it and you say, well, it's not doing anything. Well, listen, it is doing something. It's not losing value. It's not gaining value. No one stole it. It's completely liquid. It's FDIC insured. This is not a time in your life that you're going to start speculating. This is a time in your life where your biggest concern should be that you're not digging into it on a monthly basis.
Well, my question is, I was thinking about putting it as CD, so I can't get to it.
Okay.
Oh,
All
hey, there you go. Look at you. Listen, that is self-aware. I like that.
Yeah.
That, Faith, is very, very self-aware. Put it in a CD.
Okay.
Put it in a 12-month CD.
Don't go anywhere beside. Don't take it out of an FDIC insured account somewhere.
Don't let one of your friends. Don't lend anyone money.
Don't lend anyone money.
Don't lend any. Don't give any more to
You
your
don't have
daughter.
enough to lend.
Don't give any more to your daughter.
Okay, what I was going to do is just go ahead and through my credit
That's
union and put
perfect.
it in I was thinking 3 to 6 months.
Nah, just
but
buy
you're saying
12.
12 months?
Yeah, because you're doing it to try to keep it away from you.
Yes.
So then what's put in 3 months, maybe you've got great stamina and you want something that you could wait 3 months. It's much harder to wait 12 months.
Yeah. Okay, my other question is, should I take $1,000 and buy gold?
No, we just told you not to do anything. Don't do anything.
Don't
Take
buy
the
any gold.
$100,000. Put it in
No,
a
I still have 18,000 left.
I know
Don't
that.
buy gold.
I
Why
don't
would you
want
want
you
to buy gold?
We don't want you to buy anything. I want you
Okay.
to enjoy life.
Gold can go down as much as it can go
If
up.
you're going to do anything, spend your time and energy figuring out how to cut your cable bill.
Yeah.
They're sneaky, aren't it? All of a sudden you're looking like. how
But
much
by the
I
way,
pay?
you can call and tell them that you're going to quit, and they will lower. They'll actually they'll transfer
she
you to
just
what
moved
they
into
call.
the place, so I don't know what she's.
She might have transferred her cable from her old. So,
All right.
But that's what you want to worry. Put it in a 12-month CD. Don't touch it. Don't buy gold. Don't buy any investments. Don't lend the money. Pretend it's not there. Try to get your expenses lower so that you have a little bit of surplus money at the end of every month.
Yeah.
All right, Faith?
Glad you called, Faith. We wish you well. And it's interesting. If there's somebody listening that are saying to themselves, here's what they're saying. Well, they didn't talk about inflation. Inflation could be a problem for her. And because she's 71, she probably has many years. She should probably have a portion of her portfolio in stocks so she could have some growth. This would be a textbook kind of an answer.
Yep. And I read a review of our radio show recently that said that we gave bad advice because of it. Almost exactly that.
Okay.
That
It
these
works
guys
fine
didn't know what they were talking about because this
until you
older
advise
lady,
people.
this 71-year-old lady that
Here's my experience. Somebody in life who's further down the road in life, no longer working, now has more moderate assets, fixed income, who has no experience investing in assets that fluctuate in value greatly.
Yes.
I've yet to see any of those people do well with investing in stock funds, etc. I see people who inherit money. I see people who've won the lottery, people who've gotten settlements of from a variety of different things. And I got to tell you, and you're the same thing. 95% of the time, it doesn't work out well for them.
Because of market
They
volatility.
freak out and they sell at the wrong time, and then it's just the worst thing for them.
If you're listening to this radio show, remember we're giving people advice about their money, their particular situation, not my situation, and not you listening to this situation. We gave Faith our opinion on her situation.
From what we know, thus
From
far.
what we know.
And by the way, we always tell people to go seek their own.
That wasn't hard.
Yeah. Let's continue on with calls. 833-99-WORTH is the number. Numerically, it's 833-999 888-848-6784. Let's talk to Austin. Austin, you're with Allworth's Money Matters.
Hi, guys. Thanks for taking the call. I really appreciate it.
Yeah.
I'm just looking for a little clarification on two issues regarding the mega backdoor Roth strategy. My wife, who is 61, is in the process of exercising the mega backdoor Roth via her 401k, her Fidelity 401k at work. Her plan, with plans to later roll those contributions, the basis, into her Roth IRA at Vanguard. We have researched her plan and are pretty confident that the 401 supports the strategy. Her company also has a 401k matching contribution and also makes a pension contribution for each pay period. We are under the impression that the sum of the four contributions, her 401k pre-tax, the company match, the after-tax contribution, and the pension, cannot exceed $63,500 per year, $63,500, and not the $57,000 because she's over age 50. Does that sound correct to you?
Well, did you include
Include all the contributions.
Yeah, but you didn't include the defined benefit contribution, or you did?
Yes, I did.
Okay, well, that's the
401
Sounds right. I mean, I don't remember that number off the top of
no,
my
but
head.
it was the defined benefit. So, is there a monthly pension that she will receive in retirement?
Yes.
I don't believe. I may be wrong, Scott, but I don't believe they include the defined benefit contribution into the cap.
So if that was the case, then she could increase her after-tax contribution if we were to pull that amount out, if I look into that?
That's right.
Yeah, here's what's going on for the rest, right? So,
but wait, Scott, wait, one question before I go. How did you know what their defined benefit contribution is?
yeah.
Well, it's in her paycheck. It's in her pay stub.
Well,
Are you
then
talking
maybe,
about her defined?
What are we just discussing the same thing here?
The company pension I'm referring to.
Did she work for a state or municipality?
No, private corporation.
And it says, here's how, is she going to get a monthly pension when she retires?
Yes.
And it says on her paycheck, this is how much they're contributing to her for her account.
Each pay period, yes.
Is it a cash balance account where they froze the pension years ago?
Well, she's still employed with them. It's still active.
I
No, I understand, but it's the pension at one point
It
in
has to
time.
be. I don't know how else
Does
she
she
can have her
work
own.
for a utility or a large oil company?
No.
Yeah, I feel like is it bigger than a bread box?
Yes, it's bigger than
Is it a hairy animal?
So what we're trying to determine here is why that shows up on the
That's
statement.
weird.
Because
Unless I think it's a cash balance pension plan.
in which case we don't know the answer.
Yes, that is correct.
Okay, I'll look into that. I
No,
really
no, we
Well,
don't.
and what-
but
yeah,
let's, and the
It's
reason
just it's such a small.
we
Someone asked me the other day, how often do you get questions? I said, well, it's something esoteric that it's 1 in 100. You see, you forget
but a cash balance plan would still be considered a defined benefit plan.
it's still a defined benefit, so it would probably not. It's not the kind of question you're going to be able to.
I don't know if
Unless
you're going to
somebody
be
who's a
actually
specialist
going
in
to
this-
get to an answer, because if it is still considered a defined benefit plan,
Then it
then
would
I
not
don't
come-
believe that the defined benefit plans would be included
Because
in that
those are
$63,000.
defined contribution limits.
That's right.
And it's, by the way, it's the solo K limit. It's the limit of all the monies you can contribute into a 401k, which includes the employer's match, any additional contributions to the employers, and some plans permit an after-tax contribution above the annual limits. That's what Austin is
It's asking about the mega backdoor.
Yeah, which I've never heard it called
I've
that
never
way,
heard it
but-
called the mega backdoor.
Figured out what you're going
I've heard it
after.
called the gargantuan or the fabulous backdoor, but never the mega.
I like what you're doing.
I like the concept. My guess is that the defined that this cash balance plan. Look to see.
I think it's a cash balance plan.
Yeah, look to see if it was a defined benefit plan that's been converted to a cash balance plan, and if that's what's showing up on the paycheck.
Which looks kind of like a 401k. Does she have a balance in that account?
Yes.
That's what I was
Yes, it does look very. In fact, it's the same percentage from her paycheck that the matching is.
So she used to have it. It used to be that she works for the company for X amount of years. She gets the X dollars. They froze the plan, replaced it with what's called a cash balance plan. She could still convert that into a monthly paycheck, but it is a strange hybrid that companies adopted to save them money on their pension and it shifts some risk away from themselves.
And they knew what the outcome was.
If I were a
so what
betting man,
industry is it in, Austin? Just tell us the industry. You don't have to tell us the name of the company.
Retail.
Oh, it's an old line company though.
Yeah. It's like either a Mervyn's or Sears.
Mervyn's, are they still in business?
Sears.
Are they still in business? I don't know.
Sears is still around.
I'll look into that, and I really appreciate it. If I may just ask a second question, she'll have about $15,000 of the after-tax contributions into the 401k. Yep. Would you recommend that she go ahead and she has also about $150,000 in her pre-tax portion, and I understand the pro rata rules. Would you recommend that she go ahead and make that in-service rollover to Vanguard in January, or wait a while and build it up a little bit more, or what are your thoughts on that?
I don't think it matters. And I don't think you have to do the whole thing either.
I would just focus on taking the $15,000 after tax out.
You don't have to worry about the pre-tax.
Okay.
That's what I would just do. And you got it once a year. Take it out before so you want all the growth to occur in the Roth IRA, not in the plan.
Yeah. So
the problem with the after tax in the plan is all the growth on there is tax deferred dollars. In the Roth, as you understand, all the growth is going to be tax-free dollars.
But you don't have to worry about the pre-tax dollars in the plan. Just roll over the after-tax dollars.
Sounds great. Okay, guys, I really appreciate it.
You obviously know what you're doing.
No kidding. And by the way, it sounds like a cash balance plan, but
it's a cash balance plan.
But we believe it's a cash balance plan.
And I've yet to have this situation present itself to me personally.
No, it's interesting, but
you'll find the answer.
Yeah.
And my guess, if I were a betting man, it would be that the money going into the after-tax plan, although it looks like a 401k type match contribution, is going to be excluded from the limits of the contribution.
$63,000.
Yeah.
So
now that's not entertaining radio.
If that isn't radio, that you got to just call the kids, wake the neighbors, get them all up. That is some fascinating radio.
You're going to call
the
kids and wake the neighbors.
You're going to wake the neighbors and call the kids. You're going to wake the kids and call the neighbors. Wake the kids.
You've said that ever since I've known you. Wake the kids, call the neighbors. Did your mom say that or something?
No, it was David Letterman.
Oh, it was?
Back in the day. He used to always say, call the neighbors, wake the kids. Late night television. This is such a fabulous show.
He never had kids. Oh, he had kids when he was like 90.
Kid. Yeah, when he was 90.
Not 90.
He's got that big beard now. He just came out with a new series. Have you watched him where he interviews? So he interviewed Barack Obama. I think he interviewed Bruce Springsteen.
You find him on
Netflix.
The dark web?
On Netflix. He just came out with a new series. My daughter was telling me about it. He interviewed.
Oh, really? I'm going to watch it. I like Letterman.
Yeah, she told me
I can't find anything to watch. There's so many different. I kid you not. I get very frustrated trying to watch television.
She told me there was 4 that she interviewed. I enjoyed the last series, and then she said one was like a rapper or something. I'm not going to watch that.
All right, let's go to the calls here. Let's
what?
We're talking about what our television preferences are.
I'm thinking about it.
All right, yeah. There's Pat's like, what is that? Let's talk with James. James, you're with Allworth Money Matters.
Thank you. My question is how do you determine when and where to pull your income from if you have different sources for retirement, like a IRA, Roth, 401k, 403b?
It's going to be driven two ways. One, your income needs. Two, both current tax structure and projected future tax structure. And then we kind of work backwards from there.
So first of all is what you start out with is, do I actually have a large enough asset base to
retire?
That's the first question. And how do you get there? Well, you start with your income needs, and the income needs say, this is what I'm living on today. So if you make $100,000 and you're putting $15,000 in your 401k and you're putting 7.65% into Social Security, and FICA taxes, then you know that you're actually living at about 77% of your income. Let's just say that you're putting money in a mortgage, but the mortgage will be paid off in retirement. You're going to get down to what you need to live on. Then you work backwards to see if your asset base is large enough to support that after-tax need of income. And then the last step you say is, where is that money coming from? Right?
Okay.
So my recommendation
are you
to
retired or still working, or what's your situation?
Still working. I have 3 more years. My wife has 5.
Okay.
She'll be getting a pension, and then I think we could do fine on that. And we're just wondering if we should start pulling money out of the IRA and rolling it into the Roths.
Oh, maybe, but probably not. So is your home paid for?
Yes.
Okay, and how much money do you have in IRAs or 401ks, what they call qualified dollars?
900,000.
Okay, and how much money do you have outside of IRAs?
In the Roths, we have 244,000.
Oh, good job. And any money in a brokerage account?
Yeah, just 28,000 cash and stocks, and then she has 74,000 in a 403b.
And how much will her pension be?
About $5,500 a month.
And how old are you?
57.
And will you both be eligible for Social Security?
She will not. I will.
And do you have any pension?
No.
How much is your income today? Gross income.
Combined?
Yeah.
About 160.
And how long has it been since the kids have been fully self-supportive?
Well, our daughter is. Our son, he lives with us. He's has some learning differences, so he may be with us.
Got it.
Okay, so this is going to be, and I assume you're both making the maximum contributions in towards your 403b and your 401ks?
I am, and she's not. We don't do the 403 any longer. Back a long time ago, we decided not to do that anymore and just go into the Roths. But I'm doing the max on the 401k. I'm doing 50% right now.
I don't know if that was the best idea.
Well, it's where we are today.
I understand, but he's got 3 years to go to retirement, so I don't know if I would continue that.
Okay.
So from what we look, this is going to be tight. So you're asking how much? Where should I take the income from?
It might be fine. I mean,
He's got 3 years.
3 years. She's got another 5 years.
Oh, got it.
He's going to have Social Security as well. Her pension's going to be pretty
$5,500 a
There'll be a
month.
couple years of bridge.
Correct.
Between now before she retires.
Here's what.
You might want a little more. The years between, if you're going to retire at 62, she's still working, or 60. How old are you today, James? I'm sorry.
57.
57. Yeah, so you're going to retire at 60. You'll need some bridge for a couple years before her pension starts and before Social Security starts. And the thing I'd be looking at, where are those additional dollars going to come from?
And I would actually, I don't know. I think I would probably max out the 403b before I funded the Roth.
I would too, at the tax level you're at.
At the tax level you're at, and you don't have.
Are you in California?
Yes.
Yeah, I would.
Yeah,
too.
yeah. I would use that before I use the Roth. And here's what I want you to do. I want you to think about your retirement, and you can go to our website, allworthfinancial.com, and watch the 7 personal decision points of retirement transition. It's called the 7 personal decision points, and it talks about exactly this, the retirement transition. We give examples, and you could actually kind of do the math on your own, or you could call and talk to one of our advisors, and they'll tell you how much we charge to do a financial plan. And you can call, and they'll give you 15 minutes for free. And you'll do a Zoom meeting or a phone call, whatever. But I'm not. Well, I guess I am promoting that, but I'd like you to watch the 7 personal decision points. And then we have a chat bot, which is the personalized learning platform on our website where you could actually ask.
Here's the thing.
You go to our website, there's tons of resources.
Pat, if you're having dinner with James, how old are you?
57.
Okay, you guys are the same age. If you're sitting having dinner with them, you'd say, James, come on, get a financial plan. You and your wife need to go through the process together with a financial advisor and get a financial plan. So either through us or through somebody else, you're right in that perfect window.
But you're not
with the right kind of planning.
But it's not clear cut, Scott. It's not like, oh, this is going to be a breeze.
I understand.
He didn't say his IRA was $1.5 million. He said it was $900,000.
I understand. And you've got a child with some special needs
So
that
you
might
need-
require some
You need a
special planning.
You need a living trust with a special needs provision in it as well.
We have that.
I'm assuming
Good.
you're. But at a minimum, go.
You
and
guys
watch.
go meet with the. Again, you'll be glad you met a quality financial advisor. I think.
But you've got a lot going for you. Your home's paid for. You've got a lot of money.
I think you can make it happen. You
Yeah.
just need to look at what some of the trade-offs are here and there.
Yeah.
Okay.
All righty.
All right.
Appreciate
Thank
the
you.
call.
All right.
We did not answer his question. He wanted to know exactly how to take the money out of the accounts. We don't know.
We don't. Well,
We don't know based on this information.
based upon what I've heard so far, so I want to make sure there's enough cash for a bridge before his Social Security starts and before his wife retires.
Yeah, but he'll be 60, so maybe he starts taking it out of his IRA. Maybe he doesn't. Maybe he takes it out of his IRA and some out of the Roth IRA as well.
Or
That
maybe
would be my guess.
Or maybe we try to save more in a brokerage account on the outside between now and retirement
Yes.
to have some. So there's
All of those opportunities.
And look, when we're retired, it does make a tremendous difference how we source our retirement income. In a perfect world, we get to retirement and we have multiple sources to draw upon. We have money in our 401k and IRAs, our tax-deferred money, the traditional tax-deferred money. We have money in Roth IRAs that are going to be designed for tax-free. We have money that's set up in brokerage accounts or in maybe it's some mutual funds or ETFs that we've owned for many years, or particular stocks that we've had, some outside investments that have they have a capital gain tax trigger on them or qualified dividend treatment to them, so they're different. We might want some in some municipal bonds. We might want some in some real estate. In a perfect world, we get to retirement and we've got many different buckets to choose from. And then as tax law changes, which it does.
You change your distribution strategies.
And every year you take a look at it and you look at what's the current tax situation, what's it going to look like, as best we can guess, the next year, the next 2 years, the next 5 years, what are the probabilities down the road, and then we make our best assumptions and make decisions. And it can be very fluid. You might know exactly what your retirement income needs are. You need $80,000 a year, whatever the number is. But where those dollars come from could change on an annual basis depending upon tax law. And that's what a good financial advisor will do, is help you figure that out on an annual basis. So anyway, we're out of time. As always, it's been great being here with you. If you don't listen to us via podcast, we encourage you to. It's a great way to listen to it. You can listen to it whenever. Just go to wherever you get your podcasts. Or if you don't listen to it now, go to our website, allworthfinancial.com. It'll walk you through it. This has been Scott Hansen and Pat McClain of Allworth Financial. Enjoy the rest of your weekend.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.